All right, guys, welcome back. I know it's been a little bit since I've made a video, but if you guys have been following me, you know that I've been traveling quite a bit. So I'm back in California. I'm actually up here at my cabin, as you can see. So just kind of enjoying the snow and a little, kind of getaway and stuff. So, I mean, not that the beach isn't beautiful, but it's always cool to change things up and kind of check on your investments. Anyways, today I want to talk about credit. And if you guys listen to my podcast, and you know that I said I was going to make one on this a little bit more in depth. So I guess we'll just start with why credit. So credit's important because it helps you, buy things without having to use your own cash. Kind of in just simple terms. And just so you guys know, I'm no financial advisor or anything by any means, but I've been in the car business for a long time, and I actually got loans funded and deals bought for people who were buying cars. So I know a little bit about it, and I've helped out some of my customers, family members, and friends on rebuilding credit, and also guiding them in building their credit as well. I would say, credit's just important in case you want to buy something like these investments that we talk about as far as real estate, or, if you want to get a good deal on a car as far as not paying too much. I've had customers over the years who have, good money and down payment and everything like that, but their credit's not so great. So they're paying a lot more than somebody else would pay for the same car. So let's just start first with, let's just say you're brand new to credit and you're a young person. I would say try and get a credit card as soon as you can, but be careful because you want to spend wisely, and you want to spend on things that you're going to be using anyways, and pay that off every month so you're not paying interest. You want to use it as a tool. You don't want to get sucked into buying things that you don't need and then just paying the minimum payment. You want to go and find, the credit card that's going to cost you the least and get you the best points, or whatever you are trying to tailor it to, whether you want points for flights or gas rebate. That's the one I started with when I was a kid, because we're all using gas when we're driving around, right? And then if you want cash back rewards, I've got a Costco credit card. I just picked up $383 cash from Costco for just spending things that I normally spend money on. So I try and put everything on my credit card so that way I can build those points up and get those rewards. So for someone that's young, I would say if you can, get on your parents, be an authorized user. I didn't do this myself. I didn't really have that option. My parents, didn't do that with me. I've seen people do that, and I'll be honest with you, in the credit world, sometimes they don't even see that as anything, because you're just an authorized user. You're like a third person on these cards, and they kind of know what it is. So if you can, do it before you're 18, but I believe 18 years old is when you are able to do it on your own. So I got a AAA credit card. Yeah, I know a lot of people are like, wait a minute, why are you handing me your AAA membership card? And I'm like, no. This is actually a credit card, and it was a gas rebate card, because when I bought my truck, I mean, you got to put gas in it. So basically, I've had that one since I was 18 years old. And then, I got the Costco credit card after that, because when I was living with some buddies, we'd use my card, go and buy everything at Costco. They'd give me the cash, and then I would get the rewards, and it just kind of like helped build my credit from there. So you kind of start there, and then you go to bigger things. Then you go to maybe financing a car. As I had explained before, probably in prior videos and the podcast, is that I bought a car to help build my credit to get a house. Nowadays are a little bit different. It seems people are buying houses without buying cars, and that makes sense, because as I had mentioned before, cars are harder to find than a house. I mean, the bank can come and go and kick you out of the house. They can't go take the car back from you unless they put a GPS tracker on it or something like that, which is very rare. That's if you have really, really bad credit. So, but you just want to get a better deal. So you want to build your credit these small, easy ways. Now I'm going to go into a little bit later is, people who need to rebuild their credit, they want to start with a credit card that's a secured card. And if you're new, you may have to start here as well because they don't trust you. They don't know how you're going to spend your money. This is how it works. If you're a zero, or even if you have a good, let's say, score because of something else, because you were put on your parents' card, they still don't know how you actually spend your money. So a secured card is basically where you'd go in, and I'm not promoted by Capital One, but Capital One, they give a lot of chances to people who have gone through bankruptcies or new to credit. And so you go there, get a secured card, probably start off at $200 or $250, and you would basically give them your money, and then you would show them how you're spending your own money. And then from there, they're gonna kind of, see it, and in a certain amount of time, they'll come to you and say, okay, well, now you can get a credit card, or now you can up this and then you can get a credit card. So I would say definitely start there. Don't overspend on the things you don't need. Just do it for the things that you do need. Pay it off every month so you're not paying the interest, because a lot of people are like, oh, well, I don't want to owe anybody anything. And I understand that. I really do. Cash is good to have around. And I know some younger people don't even like to use cash, especially with all the crypto stuff going on now. It's just kind of changed things. But I like to have cash just in case of emergencies, because sometimes there's certain places that will charge you for having a card. So I don't like that. I think that's, it's kind of a waste of money, right? Because you're going in and say, okay, we're going to charge you 75 cents because you're using a credit card. Well, you're buying something, let's say, I don't know, $5, $10, maybe a little bit more, but most of the time you go into, certain places, and they're going to charge you 25 to 75 cents on something you're just buying, like a drink or something. And it's just, to me, that's why I like to have cash around, because I'm not going to get charged. I mean, the percentage wise, when you think about it, I know it's only 25 cents or 75 cents, but if you're buying something that's $2 or $5, we're talking 10%, for example, is like 50 cents or whatever, so you're paying a lot of money, just to buy something that you would normally buy. So anyways, as far as, building your credit, start there, get a secured card, or get a credit card if they allow you to get one, and then just use that. And as time goes on, don't max it out. So maxing it out, basically, say you have $500 and you're spending all $500. Well, that doesn't look good, because you're basically spending everything that you have. So you want to keep that, less than half, I would say, is the rule of thumb. So if you get a $500 card, keep it around $200, revolving somewhere around there. And like I said, pay it off every month. And that'll help kind of build your credit. They'll see, okay, cool. And then get another one. I would say, if you can get 3 of them, take one of them, cut it up, and don't even use it. Because what that's going to do is that's going to show, okay, you have $500 here that you have available, and then you have these other 2 cards that maybe one's gas points and one's cash back. Okay, cool. So you can kind of use those, or depending on which stores they give you more points for, you can use those. I wouldn't say have too many. I think myself, I have 4 personal ones, business one, and so I mean, you don't really need a lot. You want to kind of tailor it to specific things that you want to build, points for. And so cutting one up is kind of good to have, just because it's showing that you have that money still available, and you want to use it every once in a while so they don't close the card out. This is the biggest thing that I would say a lot of people do, especially when they're going to try and repair their credit, is they'll pay them all off and then they'll get rid of them. Well, that actually hurts your credit, because now you had, okay, say you have $5,000 worth of available funds, and you go and you're like, oh my gosh, I'm spending too much, and you pay them off, and then you get rid of them. Well, now you get rid of one, you gotta take $1,000 off of that, and now, okay, you only have 4,000. So you're basically actually reducing what they see that you're able to actually manage. So don't get rid of them. Try, and especially like for the people who have a lot of credit cards right now and they need to go through and pay them off, don't get rid of them at this point. Just don't get rid of them. Maybe slowly, one at a time, but don't get rid of all of them or most of them. Just pay them off, keep them there, use them every so often. So use them just often enough to where they don't close the account, because that actually hurts your credit. Okay, so now for the people who are, say, trying to rebuild their credit, honestly, it's kind of sad, but from my experience, especially in the car business, is people who have had bankruptcies. It's a lot easier for them to rebuild their credit than, say, somebody who's had like a foreclosure or a repo on their vehicle, meaning the bank has taken that back. That shows really, really negatively on your credit, and it's really hard to get rid of that. So bankruptcies actually, I don't advise them, um, especially for the people who don't have a lot to put in them. Because if you only have, $40,000-$50,000 to go bankrupt with, I don't think that's fair, for one, because that's stuff that you owe, and so that's kind of a cop out. But certain circumstances, of course, may warrant different things. Now, I know everybody's got their different things that they're going on with their life, but unless you've got just, I don't know, like tons and tons of stuff to go bankrupt with. I'm not saying, like, I mean, for myself, I hope that I never have to do that. But if it's business wise and smart, and this is what my advisors are telling me, then I may do it. But I don't ever want to get to that point. Honestly, if anybody knows me, they know that I try to be as frugal as possible and take risks, but also be, aware of what I'm doing. So anyways, now bankruptcies are actually an easier way to rebuild. If you have a repo or, repossession on a house, then that's definitely a little bit harder to get back from. So you're going to have to start at the ground level, like I said, probably with a secured card. Just really depends on, what these certain places are allowing you to do. I wouldn't go out and try and get too many because at a point, if you're running your credit too much, even if it's low, it's just still going to keep on dinging it and dinging it. So for me, from my experience, just for you guys to know, like I said, I'm not sponsored by Capital One, but I've just noticed that they are really easy to work with. Or if you've had a credit union, and that's something that I have told people as well, is keep a credit union in your back pocket and get something, get like an account from them and just keep it for a while. Because if they see, oh, okay, they've been a loyal customer for yada yada years, then they may be more willing, because they're not so big and not so corporate, and you can actually go and talk to somebody, and we're all human and everything, and they're just a little bit more friendly and things like that. So I always do have my a couple credit unions, just depending on what I'm trying to do, just because if I want to refinance something down the road and it's kind of tricky, I go talk to them and say, hey, what do you guys have to offer me? So definitely do that. And then, like I had said on our podcast, is if you are trying to rebuild your credit, there's the freecreditreport.com. It doesn't cost you anything, and it doesn't ding you. You get it every 6 months. And I think with COVID, they've actually changed that up to where you may be able to do it a little bit more often. You guys will have to check into that depending on the different bureaus. There's 3 different bureaus: Experian, TransUnion, and Equifax. And so some of them report a little bit differently than others. Certain banks work with different ones. So when you're trying to get a loan for, say, like a house or a car, the homes, they'll run all 3. Cars, they may run all 3, but some lenders will only look at 1 sometimes. So as far as which ones to look at, it really... I don't know. I would say Experian, I guess, maybe, is one of the bigger ones. It really doesn't matter. Just go on to the annual credit report, pull all 3 of them, go see if there's any differences, and if one's reporting different than another, and then print that out and go line by line. And if you're like some of the people who I've helped in the past, you may have medical issues or small little collections that are tiny, like $150, $200, or somewhere, under $1,000. I mean, those things are hurting you, even though they're so minuscule. I would say go through those, call those companies, and a lot of times they'll have that on the credit report. They'll have, okay, if it's gone to collections, now it's going to be a different company, and now it's showing, oh, the original one was this, and you have that on your credit, and then you have the collection agency on your credit now too. So go on there, print that out, call them, say, hey, you know what, I'd like to settle. What would it cost me to settle? and they're going to say whatever amount. You maybe can try and negotiate with them. I know people use these credit fixing places. Personally, I haven't had the best experience with them. I've done better than them for some people that I know who've tried them out. Now, I know some people who have found some that are pretty good, and things have changed over the years, of course. So you could do this yourself, though. And if you can't get it done, then you can maybe try and find somebody that can do it differently than you. But just call them, say what will you settle for, and then they'll say this and that. Well, make sure that, hey, okay, I will pay you that as long as you take it off my credit. Because I've seen people go and pay them. Okay, cool, I paid it. Well, wait a minute, they didn't take it off my credit, and now it doesn't even matter. It's like, why even pay them, right? So not saying that you shouldn't own up to your stuff, because those things can linger on your credit and they can keep on bouncing and bouncing and bouncing for years. That's another thing too, actually. That's a really good point, is some of these ones can just keep on getting resold. So it could be, it could have been 10 years ago, and statute of limitations or whatever on your credit say, certain things will drop off in a certain amount of time. Well, if they keep on selling it and selling it and selling it, I mean, the thing can go for a ways. So you might as well just nip it in the bud, get it over with, and then be done with it. Okay, and then medical ones, obviously, everybody has those. So some lenders will see that and, be a little bit more lenient with. But if there are those things that you can get off, just call every single one, see if they'll settle, and see if they'll take it off your credit. The harder ones are going to be, like we said, bankruptcies show up, I believe, for 7 years, depending on the bankruptcy. It's either 7 or 10, depending on if you what chapter that you file. So that you'll do your own research on. I'm not an expert in that, but there's certain things that will take a while to drop off. But as long as you rebuild in the interim, like, don't go and ruin your credit after a bankruptcy. That is like the kiss of death. So just be really aware after a bankruptcy to not get yourself in the same situation again, because my gosh, there's a few people that I've had that is just, I feel so bad for, because there's really not a lot you can do, and you almost have to go and just buy things cash for so long, and to just take a long time to rebuild. So please don't do that. And if you've done that, then like I said, you're just gonna have to start with probably a secured card and go from there, because you're just really going to have to show and prove that you can do things differently this time. So, all right. So there's that. And so I know I'm like rambling a little bit, but I think you guys get the point. Just make sure that if you're starting off, you be aware of how much you're spending. Don't overextend yourself. Now, if you're trying to rebuild, then, take it slow, start rebuilding up, start repairing. And don't neglect it. That's a lot of things that people do, is they just keep on pushing it off and pushing it off. Well, then when it comes down the road and you want to go buy a car or go buy a house, it doesn't mean that you can't do it, because you can have a certain score and still get a loan, but you're not going to get the best interest rate. You're not going to get the best loan to value. So you might have to put more money down, or might have to have a higher interest rate. And so it's like, why would you want to pay more for something that somebody else doesn't have to? So definitely just keep aware of that, and then let's see. As far as, I guess, let's go to making it even better. How about that? So once you've built it up and everything, what you're going to want to do is to show the banks that you can really manage money, is start getting higher balances on the credit cards. Now, if you're doing really well, a lot of times they will offer you more. Always accept it. Even if you're not going to spend more, just have it in your back pocket and always accept it. Because when you go and you try and ask for it yourself is when they run your credit again. But if they say, oh, hey, we got this offer, you can up your limit now to $10,000, do it. Because at that point, they're not running your credit. They're just basically kind of, giving more. And then what you can always do too is you can update like your income. So say if you're making more, you can go in there, and a lot of times they'll allow you to update, okay, well, hey, I'm making this much more, and then they may end up giving you a little bit more on your credit lines. And now when, say, somebody like me who's looking at let's say a home loan or a car loan, and they're going to look on there. Okay, the banks are going to say, oh wow, they've got all this. They're not spending that much. So okay, cool. Yeah, we can loan them this now, and then you get a car, and you get that car, and you build that up. Now I've got $25,000 loan on my credit statement now. Okay, they can do that, and then you just keep on building it up from there, and you build it up from there because say you want to go in and like I worked at BMW, and some people would come in and like, oh, I want to get a BMW, and it's a $80,000, $100,000 car. Oh well, I've got a good credit score, but have you financed anything with that similar kind of loan? No. Okay, well, how does the bank know that you can manage that? Even if you have, good income, that doesn't always justify it. And everybody's different. So that's the thing, is like everybody's different, and sometimes things just get pushed through because, there's an electronic system and whatever. I've seen it happen before, right? So, sometimes people get lucky and, but still just be mindful of how much you're spending. And this goes to a lot of the podcasts that we talk about is just don't overextend yourself. Don't get into a situation you don't need to. I mean, if you're buying $100,000 car and you don't have a house yet, I really don't agree with that. I think that you should be investing in a home first, because then you can have that money work for you, and maybe not necessarily your house that you live in, but an investment property that's making you some cash flow to be able to pay for that car. Everybody's different. Understand that. That's cool. For me, I did go through my phase when I was 25 years old. I bought a Audi S5. It was like $60,000, and my payment was almost $800 a month. And I know nowadays maybe it doesn't sound like a lot because things are just getting so much more expensive. But I mean, it was a lot of money, and I'd had 2 houses already. But I actually sold that car after having it not even a year because I had too high of a payment, so I couldn't qualify for the next house that I wanted to buy. So good thing I got a good deal on it. Sold it to CarMax, dumped it, and I was able to qualify for more house. And then I just got, I got a less expensive car with half the payment. And I was like, okay, I'm kind of done with that until I get to a certain point. I don't think that it's really necessary to get a really expensive car, because obviously they're depreciating assets, unless you were to buy something that's collectors or something like that. But then that's really going to cost you a lot of money, and hopefully you have some investment properties before you kind of invest in cars, because even if you get a good deal on a car is not really an appreciating asset for the most part. So anyways, yeah, like I said, just be mindful of your spending. Try and keep on building those limits up, and then buying things. Even if you have cash for certain things, it may be a good idea to buy things on credit, especially now with interest rates so low. Buy things on credit, and that way it shows on your credit, hey, I had this $50,000 car, even though you could have paid cash for it. I did that with my truck. My truck was about $50,000, and I could have paid cash for it, but I mean, I got, I think, 2% interest rate or something ridiculous, where it's so cheap, and it's like, why even pay it off? I can take that money and I can go invest it in a property, and I can make money on that money more than what I'm paying on my interest. Even though I don't like payments either, but that's going to just show another thing. Once it's paid off, okay, he's got all these paid off car loans, all these, and then when you refinance a house after you get houses, you have a paid off home loan and stuff, so all those things is really just kind of build you up, get you higher. And then, like I said in our podcast, was 700 credit scores, decent, 740, decent. But if you get over 800, there are some programs for certain things that a lot of people don't know that will actually get you a better rate. And depending on what it is, a lot of things, if you have a 700 or an 800, really doesn't matter. But there are certain things where you may get a little bit better deal. So it's like, why not try and build your credit up as much as you can, as fast as you can. Now, they do take into consideration how long you've had credit for, and that's why I will tell people to start as young as you can, because they do look at time that you've had it, and that does the algorithm, whatever, has that algorithm on what creates your score. How it's created, I don't know. I've had customers who bought cars from me that work for these companies, and they still don't know how it works. So don't try and figure it out. just do what I said, and just try and be mindful of what you're spending. Try and build your credit up and pay things off, You know, like some people, I'll tell them, especially if their credit is kind of low and you have the cash to buy a car, you know, try and go and see if you can finance half of it, bite the bullet, because buying a car actually does build your credit pretty quickly compared to a lot of other things, because it is a larger balance, and like we said, it's harder for them to find. So if you can get a car, say it's a $10,000 car, okay, I'm gonna go pay cash for this car because my credit sucks. Well, if you can get someone to finance you for half of that and then just, you know, pay it off in 6 months, or if you can last a year if the interest rate's not too horrible, try and go a full year, because then they're gonna see now, okay, hey, they can do it, and then you just keep on building and building, and it does take some time sometimes. But anyways, that's pretty much it, guys. If you guys have any more questions, feel free to let me know. Comment below. Let me know how I did. See if there's something that I missed. You know, if you guys are into all this, like, let me know. I know we can talk about this for days, and there are things that you can kind of go in even more detail with this, but I think that's when you really need to talk to a professional, depending on what you're trying to do, whether it be getting a credit card, building back your credit, buying a house, buying a car. So just try and find somebody who's in the industry that knows what they're talking about, that can really help you out. But I'd be happy to answer any of your guys' questions. You know, obviously I'm not going to charge you or anything like that. So I'm free, I'm here. You know, I've had my experience, and I'm no expert, but if you know anybody that I know, they'll tell you that kind of I've done this a while. So anyways, guys, we'll see you next time. Hope you enjoyed the show. Catch you later.